Hi guys, welcome back to my channel. Kelvin here. I've been doing the wheel strategy for almost 1 year now, and I think I know a little more than when I first started. I hope. Just in case you blur and don't know what's the wheel strategy, the basic idea is that you sell options to generate a consistent income. So a few months ago, after I posted several videos to teach you guys how to do it, I got tons of questions every other day, which is good because it means that now you know a new way to earn money besides buying high and selling low, and 8 together strong. So in this video, I'll be sharing 8 things that I learned while selling options so that you'll become better at it. Sounds good? Let's start right now. First, only sell options on stocks which you are okay to own. This rule is super easy to understand, but everyone also does it, including myself. A lot of us will try to sell options on stocks that has very high IV, but we don't like the stocks themselves. For example, AMC has very high IV, about 200%, while stocks like Apple only has 37%. This makes AMC options worth a godlike amount compared to Apple. For example, AMC option at 0.3 delta gives about 8% yield, while Apple option only has around 1% yield. So naturally, you'll be like, wow, if I sell AMC option for 1 year, I can hold until sell liao. But you wait long because this will never happen. Look at this chart. AMC has been going down. If you sell an option when AMC is at its peak, sure, you will earn a lot. But when AMC crash, the broker will be like, now buy! You'll be assigned 100 AMC stocks and you'll be forced to become a proud shareholder of the company. The drop in price will cancel off your option profits, and when the stock has crashed enough, the 200% IB will return back to normal levels, maybe just 50% or 60% IB instead. That's when you get stuck in the stock for a long time because your options are worth peanuts now. So that's why you should only sell options on stocks which you are willing to own. If you check online, many people will ask, what's your favorite stocks to wheel? Or what are the best stocks to wheel in 2021? Those are the wrong questions to ask. Instead, the question should be, what are your favorite stocks? And if someone asks you, you must be able to say, yes, I like the stock and I wouldn't mind owning the stock over the long term. Okay, yeah? Second, I always get the question, can the option be exercised anytime? It depends, but most of the time, the answer is yes, the option can be exercised anytime. Here's why. There are 2 styles of option, American style and European style. And no, it has nothing to do with the country. US stocks can also have European style options and vice versa. The main difference is that American style options can be exercised early, while European style options can only be exercised at expiration. Now, most of the stocks that you know are American style, like Apple, General Electric, Google, while some index funds like the SPX or Russell 2000 index are European style. I tried finding a website which tells which is which, but I can't find any. The closest thing I was able to find is through cboe.com. Here, you can see that SPX is European exercise style. Same thing for Russell 2000. If you can't find what style of option it is, in most cases, it should be American style. But here's the thing, even though options can be exercised anytime, in most cases, maybe 99% of the time, they will only be exercised on the last day after post-market ends. For US, it will be Friday 8 PM Eastern Time or Singapore time Saturday 8 AM. Here's why most people won't manually exercise the options. Maybe they are too busy getting grey screens in LOL or something. But if the options becomes in the money on expiry, most brokers like IBKR or Tiger Brokers will exercise automatically for you, unless you tell them not to. The third thing that I learned while selling option is to close your option when you are at least 50% in the profit and don't hold it till expiration. Here's why. Maybe you sell a 1 month to expiry put option on Apple and you receive $300. Then next week, Apple has shot up like nobody business. The option price has dropped from $300 to $100. So you have $200 unrealized profit, right? But you still have 3 more weeks left on your option. Now, should you hold your put option for 3 more weeks to earn another $100 or buy back to close to lock in your $200 profit? My advice and the general advice is to buy back to lock in the $200 profit, because even though Apple has gone up today, anything can happen within the next 3 weeks. You already earned $200 in just 1 week, and it's a bit pointless to risk your money for another 3 more weeks just to earn $100. Another thing is, some people will let the options expire on the last day, but personally, I would just buy it back because as long as there's still time for the stock to move, it can do unexpected stuff. especially during post-market hours and especially when there's apes around. So, to summarize, don't let your options expire by itself. Always buy back to lock in your profits. Next, selling options on margin. So, here's a very interesting thing that I've discovered when selling options. When you sell a cash cover put, you will need cash to cover just in case you are assigned the stock, right? No problems there. And when you don't have cash, the broker will use margin to cover the option. Also, no problems there, right? But here's the interesting thing. When you use margin to cover the option, as long as you are not assigned any stocks, you won't be charged any interest. In a way, this makes margin for selling put options interest-free. But take note that the basic margin rules still applies. You will still need to maintain your margin requirements. If the stock market crashes tomorrow and your account drops too much, you will still be margin called. RBKR and Mumu will still call you and be like, "Hello, can you put in more money?" Personally, I've been selling put options on margin, but I don't fully max out my margin like some ape, of course. Instead, I only utilize about 10 to 20% of the margin to sell puts. And just in case I'm assigned the stock, I'm able to top up cash to buy the stock. So, should you sell options on margin? It depends. If you are still blur and don't know what's a call and what's a put options, then don't do that because you will burn yourself. But if you know what you are doing, I would say it's a very good way to earn extra money selling options. Next, the real strategy will not outperform the buy and hold strategy over the long term. So, you may be selling options to earn extra money every month. Sure, it feels very short, but the thing is that selling options will never outperform a simple buy and hold strategy over the long term. CBOE has the S&P 500 put right index, which tracks the performance of selling a put option on S&P 500. So let's compare them. There was a period where the S&P 500 was going sideways from 1999 to 2009, where it started and ended at the same price. This is known as the lost decade. During this period, the put index gave about 122% return, outperforming the S&P 500, which gave 0% return. But after that, the S&P 500 started its bull market on March 2009 all the way to 2020, giving almost 400% return, while the put index only gave half the return. So, the moral of the story is, when the market is going sideways, then selling options will outperform the market. But when the market is going to the moon, you will earn money just by buying and holding the stock. If you check online for the real strategy, you will see people recommending to sell options at 30 to 45 days to expiry and at 0.3 delta. But personally, I've modified my option strategy to get the best of both worlds. First, if I want the stock, I will sell the put option much nearer to the stock price. So let's say Apple is $146 now. Instead of selling at 142, which is at 0.3 delta, I could sell at maybe 145 or 146 so that I can get assigned the stock much more easier. Second, when I own the stock, I will sell weekly option instead of monthly option. By selling weekly option, I will earn more money and I can adjust the strike price every week depending on the current stock price. Besides that, I will also sell at a much lower delta. For example, if I own 100 Tesla stock, instead of selling at 0.3 delta at $700, I will sell about 30% price distance at around $850. Sure, I will only earn $55, but the 30% price distance lets me keep the stock in case Tesla moves 10 to 20% in a week. I will just treat that $55 as weekly dividend. This has two benefits. My main strategy is to buy and hold the stock, which should do well over the long term. And at the same time, I get to collect dividends from growth stocks by selling options. Next, I have a viewer asking me this question. What happens to the money I collected if I close the option? So, when you sell an option, you get to keep the money that you have collected. You just need to pay the current option price to close it. Take for example, when you sell this Apple option, you receive about $110. Whatever you want to do with that $110 is totally okay. Except for KTV lah, don't go KTV. Anyway, let's say 1 week has passed and now you want to close your option. If the option is now $20, you only need to pay $20 to close the option. So for this example, you receive $110 and you pay $20. Your final profit is $90. Okay, yeah. The next thing that I learned, how to handle losses. So when you sell an option long enough, eventually the stock will go against you. And now your option will be in a loss. What to do, huh? There are 3 things that you can do. First, you better pray that your options are covered. otherwise you will incur a godlike loss. Second, if it is a put option, you can just take the assignment like a man or woman depending on your gender. Then you move on to the second part of the wheel, which is to sell call option. Or if it is a call option, just let the stock get called away. Sure, you will earn lesser money, but profit is still profit. Then move back to selling put option. Third thing you can do, there's something called rolling an option, which is basically to buy back your current option at a loss, then sell a new option at a later date. Let me show you how. Let's say you sold an Apple put option at 147 strike. This option has 3 more days to expiry and the option is now in the money. To roll the option, you can buy back at $188. Then if you choose 1 week later, you can sell another option at 143 strike for $218 premium. So 2 things happen here. First, you pay $188 to buy back your option, then receive $218 by selling. Your loss suddenly becomes a $30 profit. Second, you extended the time for the stock to move, and you lowered your strike price from $147 to $143. This gives Apple 1 more week to possibly move up. Or, if it goes down, you can continue rolling your options. But take note that you cannot do this forever. It's possible for the stock to crash suddenly and you will still end up getting a sign. So that's how you handle losses on your options. Another question which I get quite often, if the option is in the money, do I need to do anything? Most brokers will auto-exercise the option for you. If you don't want to exercise the option, you will need to roll the option before the market close on expiry, or buy back the close, or contact the customer support to avoid exercising for you. So those were the 8 things that I learned while selling options. Hopefully, now you understand selling options a little better. If you have any questions, you can ask me down below and I will try to answer them. Or you can also join my Discord group where there's a lot of pros who will help you. Link down below. And that's all for today. Like, share and subscribe as I'll be posting new videos every Monday and Friday.